All right. Good afternoon, traders. Happy Tuesday. Welcome to the Tradespoon Active Investor Workshop Series. My name is Scott Beck. I am the head trading coach here at Tradespoon, and I will be your host today as we talk about a subject near and dear to my heart. I apologize. I lost my headshot. I've lost my head. I lost my headshot. I don't have my picture for today's presentation. Happy Tuesday to you, Dennis. Hi, Mikhail. Good to see you. Some of you I just saw half hour ago, trading room, talking about what we're doing with this market. Just relax, right? Just relax. Have a plan. Execute your plan. Today we're talking about options and understanding them better. So I will tell you this. It is a basic options presentation. So if you're new to options, it's going to be fantastic. If you've been trading for options for a bit, it's going to be some review. And if you've been trading options for a while, it's probably going to be maybe a bit basic. So just a heads up. Hello, Ian. Good morning. Good to see you. Hi, Bill. Always good to have you. Good to see you, my friend. All right, let's just dive into it then. First and foremost, this is the short version of my bio. Trading 20 years, teaching 16. I started off actually working on a trading desk back in 1999. Got my Series 7, my Series 63, joined a trading desk, quickly migrated to the options desk, which was nice. I always found that I was mostly interested in options. After the market crashed in 2001 and 2, I looked around and thought I'd find a different path. I found myself going more towards trading education. 2003 is when I moved over there, and that's where I've been ever since. That's me. Good to meet you if you're new. I need to remind you very quickly that trading and options in particular may involve substantial risk and not suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks. Be willing to accept them in order to trade in these markets. Screen, still on GoToWebinar. Are you sure? What are you guys seeing? You should be seeing my disclosures screen. Um, is anybody seeing the disclosures screen? No disclosures. Uh, stop sharing screen and start sharing screen. Disclosures? Now it's there. So weird. I was saying it was sharing it the entire time. I have no idea. There's the disclosures. Okay, so now, thank you, Sergey, for interrupting me to get it right. Yeah, go to webinar. Come on, bring us your A game. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk we won't accept them in order to trade these markets. Tradesmen and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team at Tradespoon may have a financial interest in the securities presented in the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies, and each firm's material is not endorsed by the other. me see. Where am I? There we go. Oops, I clicked a link. What are we talking about today? 7 pillars of profitable trading. Choosing what to trade. And there it is. Right? All of these pillars are things that we should be addressing in our trading plan. What to trade, what product, what sector, what strategies, how to trade, how do we determine position sizing, opening, closing, and trimming positions? How do we manage our risk, basically? Signals, what's our entry? How do we avoid chasing the market? How do we know when to get in to make sure we don't pile into established trends? Psychology, being patient, maintaining a long-term focus, risk management and portfolio management. How do we always make sure we manage our risk and our reward? One of the things we've been talking about is hedging, right? Anytime you have a situation where maybe you feel like, God, did I do as well as I could have in protecting? There just wasn't much showing up that said, hey, this thing's about to drop. Hey, Trump's about to tweet something that's going to derail us here. If you're going to hedge, there's only general hedging rules that, yes, in hindsight, they work, but the next time the market pauses and it doesn't pull back, it rallies again because there isn't a tweet. Well, then when you hedge, you're going to lose on the hedge. We just want to take time. Anytime the market goes into these consolidations, you should be taking time to reflect. Right? How did you do going into the transition? Make sure your watch list is clean and you've done your watch list management. Make sure that you learn anything you can learn from anything that's happened, and then dust yourself off. Get ready for what's next. Always what's next. All of that should be constantly something we look at when we build trades with managing reward and risk ratio. Lastly, make sure you have a trading plan with rules. Stick to it. Okay, let's keep going. I don't know why my slides, there we go. So for those of you who are already Tradespoon members, of course, you know, we love you. I, in particular, love you all like family. And I don't mean like my siblings, which, they're kind of iffy. I mean, the fun extended family you like to drink with at a barbecue, right? You guys know what I'm talking about. But for those of you who are new, welcome out. We're glad you're coming by to check out what we have to offer. We hope you decide to come in. It's a great community, a lot of resources, a lot of tools, a lot of education, and a lot of really good traders that do tend to work together. So we offer these real-time predictions. We love the model. Affectionately, we have nicknamed the model Stella, the stock picker. For anyone who might be curious, if I say Stella, you know who I mean. Be like, oh, maybe we should ask Stella. Stella knows things the rest of us don't know. I mean, all artificial intelligence should have a name, right? I mean, anyone who's a Star Trek fan knows that. Gives us the ability to predict prices for the next hour, next 10 days, identifying key support and resistance levels, which are critical. Everything I do in trading hinges on support and resistance levels. That's what I like to incorporate into my trading. Okay, let's get into the presentation. I feel like I need to click 3 times before it advances my slide. What is an option? We take it for granted. I take it for granted, I know. Of back when you first are learning, you're like calls and puts, strike prices, premiums, expiration dates, in the money, at the money, out of the money, intrinsic value, extrinsic value, implied volatility, delta, theta, gamma, vega. And you're like, whoa, my head is spinning. Hopefully what we do today, assignments and exercises and all kinds of good stuff, obligations and rights and combinations and spreads, and it just gets deeper and deeper, and it's a magical world, right? I feel like I'm Willy Wonka right now, and you guys all have the golden tickets. Right? Welcome into my chocolate factory. Let me show you this wonderful world. But we have rules, and those rules are we need to understand these things. I have worked at this point, I'm going to brag, in various formats. I've done boot camps, I've done webinars. I used to do a lot of workshops, traveling around doing large workshops, but I've worked at this point with more than 10,000 traders in various formats. 10,000 traders. I've seen it, all of it, everything, at least once. And I can tell you that one of the biggest mistakes is options traders going too deep into options before they really understand what it is they're getting into. I'm a Utah guy. I love skiing and snowboarding, right? It's like when you first learn to ski and when you first start to, like, you get out of the snowplow and you start to parallel and you're like, hey, look, I'm doing it. And it's like you understand how to get going fast. What's missing in that scenario is how to stop yourself. And yeah, it's a dangerous point in time. I see it with trading, right? It's like you know enough with options to start getting into some things, but you can get yourself into a lot of trouble if you don't understand the logistics. Earlier in this presentation, I mentioned you should read characteristics and risks of standardized options. And it's like a disclaimer, and everybody just sort of is, like, oh, yeah, you should read this. If you haven't, you should. I promise. Go click on the link, spend some time. It's like 30, 40 pages. It really gives you a lot of information about how expirations are determined and contracts are issued and rights and obligations, and when you assign somebody, what happens in exercise and assignment, and this just gives you an idea of the logistics. It makes you a better informed options trader. So that's my first piece of advice. But let's go through the basics today and see if we can't get you on the right track. Should you be trading options? Well, as a very, very biased trader, I say unequivocally yes. First and foremost, you need it if you're going to swing trade. And let me explain why. Okay? Let's imagine you have a $50,000 account and you say, I'm willing to risk 1% in any given trade. That's a good risk management rule. So you're saying, I'm not going to lose more than $500 in any one trade. Okay, great idea. Now you buy a stock at $50 a share, and in this case, you decide, I'm going to put my stop loss at 47. Stop loss at 47, target at 56. Right? What does that give me? That gives me a 2-to-1 reward to risk ratio. If I get in at 50 and stop out at 47, I lose $3 a share. If I get out at 56, I make $6 a share. That gives me 2-to-1. What would give me the expectation of that? An uptrend? Maybe Stella, the stock picker, tells me that's going to happen. That would be nice. I mean, it's only about a 10, maybe 11% move. That's reasonable to ask for. But what happens next? Well, now I have this great trade, 2-to-1, trends in my favor, models in my favor. I think, all right, let's buy some stock. What do? I've got to decide how many. How many shares should I buy? Stella's not going to tell you that. But me, as a trading coach, I can help you there. I need a formula that allows me to take how much I'm willing to risk, which is $500, and then I divide that by the risk per share. So, right, a little risk management here. I take my risk per share, 500, divided by $3 risk per share. That tells me to buy 167 shares. 167 shares of a $50 stock. That's $8,350 of stock. Remember, I have a $50,000 account. That's about 17% of my account in one trade. And that's with look, I might put a tighter stop. If I put a tighter stop, I'm going to have to do even more shares. So in this case, I need the options. Otherwise, I'm going to run out of room in 4 trades, maybe 5. So in that case, I need leverage. Why do we trade options? There's probably a slide in here that talks about why we trade options, but clearly I'm getting on my soapbox and talking about it. So what's the first thing we talk about? Why? I need it for leverage. I need options. It's not that I want them. I need them so I don't run out of capital, right? That's the beginning point. Now we're starting in that situation as an option buyer. If you're learning how to trade options, that is the absolute best way to learn how to trade them from the perspective of a buyer, right? Then as you start to understand some of the limitations you have as a buyer, those limitations becoming disadvantages, you then can understand how to take a disadvantage and make it an advantage. That's what leads to selling options. Selling options leads to spread trading. That's a beautiful rabbit hole that leads us to Wonderland. And when we get down to Wonderland, there are just a world of possibilities. So can we get a copy of the slides? I don't know. I think you can from Zoom, possibly. There'll be a recording. But I'm not sure. Let me look into that. That's a good question. But it is recorded and it is posted on the site. So let's talk about what exactly an option is. An option is a financial contract. You'll sometimes hear people talk about writing the contract, right? No one actually writes it out anymore. It's just a you know, technological concept now. There's no actual writing, but somebody does have to write it. An option doesn't exist until you buy it. You're not buying from an inventory. Somebody creates the contract in order to sell it to you. Most of the time, the options market maker is the seller, which makes him the writer, right? He creates that contract and he sells it out there. Eventually, he'd like to find somebody else out there. So remember that an option market maker's job is to find balance between buyers and sellers. They don't want to have to carry inventory in anything. They just want to find a buyer, find a seller, match it up, take the difference between the two. That contract gives the buyer the right, not the obligation. Remember, we're starting from the perspective of a buyer. Buyers have rights, sellers have obligations. The right to buy or sell an underlying asset, usually a stock, at a specific price, that's your strike price, on or before a specific date, that is your expiration date. Now, it says on or before because if we're trading stock options, equity options, they are American style. Not that we are nationalists here. American style in this case means you have the ability to exercise them at any time between now and expiration versus a European option. A European option is a little bit more strict. Huh? You like that? They don't have the freedom that we have. Thank you, Sergey. And they can only be exercised on expiration day. Those typically apply to index options. So just some nice trivia about options that can come in handy if you want to be really popular at parties. Trust me, I know. Options like stocks or bonds are considered a security. They are an asset with an associated value. Those values are determined by two key components. Again, there may be another slide here, but just in case there's not, I'm going to touch on it. Those two key values are intrinsic value and time value. Intrinsic value, time value. Those values have to do with the in the moneyness. I'm sure you were not aware that in the money is an adjective, but it is. It's a descriptive word. The in the moneyness of an option, the more in the money it is, the more intrinsic value it has. The value of an option at any time is comprised of intrinsic value plus time value. If the option is out of the money, there is no intrinsic value. There is only time value. Another word for time value is extrinsic value, time value. It's a combination of both. Options are binding contracts with clearly defined terms and properties. Those contracts are enforced by your broker and through the OCC, the Options Clearing Corporation. If, as a buyer, you decide to exercise an option, now here's the thing, right? You think, oh, I have the right to buy the stock at $50 a share. Now it's at 56. Do I want to exercise that option? Well, I have $6 of intrinsic value. Hell yeah, right? Wrong. Wrong. Not necessarily. Let's say you paid $2 for that option. Well, that means that you paid $2 plus you paid $50 for the stock. That means you paid $52 for the stock, and now it's worth 56. So there is a gain of $4. Hooray for you. Well done. Wouldn't you rather pay 2 and then sell it for 6 and make $4 off of your $2? Especially if you weren't willing to risk everything? I'd rather do that. If I have an intention of owning the stock, buying a call option is not the way I want to go. I would have been better off buying the stock for $50 a share. Then it would be worth 56 and I made $6 a share. Don't buy calls to buy stock. Buy calls to control stock, then sell your calls. If you want to buy the stock, I'm going to give you a quick preview into the next rabbit hole you're going to go down with options. Don't buy the call, sell the put. You might be thinking, wait, sell the put? What are you talking about? Well, if I sell the put, I'm going to make money on that put, right? If I sell the put for $2, I make those $2. If the stock goes to 52, my put expires worthless. Then I sell another one for another $2, and then another one and another one. If, let's say, the stock drops to 49, I sold a $50 put. Somebody puts the stock to me. Now I own the put at $50 a share. In this case, I subtract. My cost basis didn't go from 50 to 52. It went from 50 to 48. Now, you might be sitting here thinking, thanks, Scott. You just confused the hell out of me, and you're welcome. My pleasure, anytime. However, let me just walk it back one step and remind you, that's the next rabbit hole. What did I just tell you? If you want to own the stock, don't buy options, sell them, right? If you're not clear on what that means, you write it down, put it on your list of things to go and learn about. All right, let's keep going. Feel free to ask questions, make comments. If you're out there thinking, God, this is the best basic options presentation I've ever seen, and you just need to shout it, go ahead, put it in the comments. I'm okay with that. I'll be all right. Let's use some analogies to understand what we're trying to do. Let's assume you're walking around a neighborhood and instead of a stock, you found a house. And you think, I want to buy that house. But you don't have the money handy for that house. You won't have it for another 6 months. What you decide to do instead is say, you know what? I've got $5,000. I'm going to go to the owner and I'm going to say, listen, I want to option your house for the next 6 months. What's the expiration date? 6 months from now, whatever that would be. February, right? I want a February option for your house. That's the underlying. And I want to do it for a price of $250,000, right? Maybe the market price of the house actually $240 or $245. So you're saying, hey, I'm going to add a little in there for you. Now, the advantage is if 6 months from now the house is worth $300,000, you've locked it in, right? Now you can exercise that option and say, hey, I'm going to sell it. But maybe you're not in the market to buy a house anymore. Maybe right? Maybe your girlfriend left you and you lost your job and you can't do it. Well, what are you going to do? You're going to find someone who is in the market for a house. And you're going to say, hey, I can get you this house for $290, right? And then you can work the deal. That's the same thing we're saying is, hey, we can sell that contract to someone else for $40,000. And then they have an option to buy it for $290 and it's worth $300. Great. You can sell that option. You could exercise that option. You can say, all right, I'm ready to move in. I got financing. Here's the $250,000. I want to buy that house. It's a good deal for you. What if the house loses value? What if the house is, let's say we go through another time like 2008. Yeah, there's some similarities we're wanting to be careful about. What happens? The house drops to $200,000. Well, the owner of the house is thinking, man, I made out like a bandit. My house is worth less, but at least I got the $5,000. You're thinking, what is this? This is worthless. I don't want to buy the house for $250,000. I could go buy it on the open market for 200. Maybe you still go buy the house. Now you're in the house for 205. 200 was what it's worth now, plus the 5 in premium you paid. That's essentially what we're doing with stocks, right? That's the analogy. So a few key points to remember. An option is just a contract that deals with an underlying asset. The contract is why this falls into a derivative. You're using the contract to trade the underlying. The value of an option is derived from something else. Remember, it's derived from a combination of intrinsic value, which is based on the relationship between the price of the stock and the strike price of the contract, right? If there is an advantage to the option, that's going to mean it has intrinsic value. The other aspect of value comes from time. The longer you have, the more you pay in time. Now, we're going to talk about this in a little bit more detail soon, but the other aspect of options, the other variable that can move up and down that will impact time value is implied volatility. Right? Implied volatility is representative of expectations. The more you think something's going to move, the more you're willing to pay for it. If I don't think it's going to move very far, I'm not going to pay very much for the option. If, however, I think it's going to make a big move, I'm going to be willing to pay a lot more for an option. That is something that we refer to as implied volatility. It is a measure, a formula that's designed to measure how much we expect this underlying to move in the next 30 days based on how much people are or are not willing to pay for options. Fear plays a big role in how much people are willing to pay for options. The more you're willing to pay for an option can be directly impacted by your fear level. If you think it's going to drop, what are you going to do? Buy a hedge. If you think it's going to drop a lot, or you think there's a high probability of it dropping, you're going to be willing to pay more for that hedge. You really want that protection. In the previous example, the house was the underlying asset. In options, the underlying asset is stock. Sometimes it's a futures contract. They do trade futures on, or excuse me, they do trade options on futures. They trade options on indices or an index. They trade options on currency, right? Foreign exchange, the Forex market. A lot of different things that have options ability. Okay. Oops, let's keep going. So let's now start talking about the specifics. There are two types, right? Classes of options. They are calls and they are puts. And once again, remember, we are coming at this from the perspective of an options buyer. I buy a call. When I buy a call, that gives me, the holder, the right to buy an asset, in this case, the stock, for a certain price within a certain period of time. The strike price is the agreed upon price determined when I bought the contract. It's not like I'm actually like talking to a market maker saying, yeah, I think I'm going to go with the 38s. And then he gives me a quote and then we spit in our hands and shake hands and we're like, deal. That's not what happens, right? I'm just, deciding what strike price makes the most amount of sense. So the call gives me the right to buy the stock at a certain price for a certain period of time. If you are a seller, you are obligated. You have an obligation to the stock. You can't be like, whoa, I don't want to do that. I don't want to have to buy that. So no, the answer is no. That would be fantastic. That would make for a very different level of trading. After that, the next step would be like full contact trading. And that does, I'm calling that's mine. Full contact trading will be a sport by the year 2029. Give me 10 years, full contact trading. If you're interested and you feel like you're in a good shape, good condition for it, shoot me an email. Okay, let's keep going. Come on, no one's going to even say anything about full contact trading? Nothing? It's getting quiet in here. I need to know you guys are still with me. There's the options can put you to sleep. And I'm making jokes about full contact trading and nobody's saying anything about it. I'm getting crickets chirping. Someone let me know you can still hear me. So I know you guys are at least still alive. Nothing? Oh, there we go. There we go. Thank you. Lee Davis said we're still alive. I just had to wake you guys up. That's all. That's all. I thought it was a good joke, but can I speak English? I'm trying, man. I'm trying to speak trader is what I'm trying to speak. All right, let's keep going. I think we get the gist of the calls. Right to buy. Let's just real quickly talk about the other side. You sell a call. You're obligated. You are obligated. So what do they want? Well, if you're a new options trader, they want to know that you own the stock, that you can deliver the stock to somebody. That makes it a covered call. If you ever wonder, what's a covered call? What do you mean covered? Covered by what? Covered by the stock you own. If you don't own stock and you sell a call, it's not covered. If it's not naked, or if it's not covered, what is it? Well, I just said naked. So if you're like, what's a naked call? That's when you sell a call option and you don't own anything to protect you. You are exposed. You're naked. Same thing with puts. Although a covered put would be if you're short the stock, and a naked put is you think the stock's going up. From naked puts, right? From naked puts, the next thing we can do is say, well, what if I don't want a naked put? Well, I could buy a put. I sell one, I buy one. Now what is it? Now it's a spread trade. So we just keep getting better, and it's like an onion. There's layers, right? It's layers. We peel back calls and puts. We find naked calls and puts. We peel that back. We find spreads. We peel that back. We find delta neutral trades, right? We peel that back. We find synthetic trades. Oh my God. Then we find ratio trades. It gets better and better. Options. Welcome to my chocolate factory, right? I am the Willy Wonka of options. All right. You should see my little song and dance. You shouldn't. You wouldn't like it. I'm just kidding. Put options, reverse scenario. In the reverse scenario, what do? Instead of thinking the stock's going up, now, I think, God, if this market goes up the next couple of days and the volume's low and the candles get weak, I think the sellers are going to smash it down again. Who's with me? Can I get a hallelujah if you think it? Smashing it down one more time at least before we really figure this out. Jones says yes. Thank you. Thank you. Yes. Amen. Thank you, David. He agrees. If I had time, I would prove it to you. I would build a case with technical evidence as to why I say that, but I say that. So when it goes up a little bit, I might think, you know what? I want to catch this with some puts. What does a put give me? Gives me the right to sell a stock at a certain price for a certain period of time. Why do I want to lock in the right to sell? Because if it's at 50 now and it's going to drop to 40, owning the right to sell it at 50 gives me $10. If I can pay 2 or 3 for that right, I have a good trade on my hand. I have the ability to buy a put. Now, if we just go ahead and reverse that again, that would give me the right. If I sell the put, I obligate myself to buy the stock. Somebody has the right to put it to me. Remember that the terminology call and put is from the buyer's perspective, the option buyer. If you buy a call, you have the right to call it out. I'm calling it out from you, right? If I have a put, I have the right to put it to you. You must take this stock at this price. I'm not asking, I'm telling. That's how options work. Calls and puts. Very exciting stuff. Very, very exciting stuff. Let's keep going. Trading terms. The strike price. That is the agreed. We have to. What's the contract for? The right to buy or sell. What do we need to have? We need to know the underlying, first of all. And we need to know at what price. That is called your strike price. Now, when it comes to strikes, I don't know if my slides are going to say this or not, but there are 3 types of strikes: in the money, at the money, out of the money. In, at, out. Now, there can be 2 strikes that are at the money on both sides. Both calls and puts can be at the money, because at the money is just simply what strike price is closest to the current price of the stock. At the money. As you start to develop intrinsic value, you have intrinsic value because you are going deeper in the money, right? Intrinsic value in the money. An in the money strike is going to, obviously, if you're going to have intrinsic value, you got to pay for it. So it's going to get expensive, more and more expensive. So if you're thinking, oh, look at this out of the money, look at this in the money option, how cheap it is. Yeah, wrong. Something went wrong. Go back and reassess. If it's getting cheaper, it's because you're going out of the money. You're only buying time value. So you're lowering the probability. But in lowering the probability, you also are picking up the potential for more profit, possibly raising the reward to risk ratio, and you are lowering the cost of the trade. Like anything in trading, there are scales: in the money, out of the money, cheap, expensive, higher probability, lower probability. Like I said, this is just a basic intro. Make sure you're getting your terminology right. Make sure you understand what it is you're getting into, etc., etc. The agreed upon price is the strike price. This is the price that a stock must go above if it's a call, or below if it's a put, for you to be profitable or be exercised at expiration, right? At expiration. Let's say I'm trading an expensive stock, Apple, or not Apple, excuse me, Google, CMG, something like that. I can start with an out of the money option and end with an out of the money option and still make money. It doesn't have to go in the money for us to make money. And remember, my objective when I'm buying options is not to own the stock. If your objective is to own the stock, you're better off working a naked put covered call Wheel of Fortune strategy. Very exciting. I know you're thinking, what? I had no idea there was a Wheel of Fortune strategy, Scott. Well, there is. I'm just saying. You might ask, are we going to talk about it? No, not right now, but I'll give you a hint. It involves naked puts and covered calls back and forth. That's your hint. Okay, let's keep going. All right. The approach. What do we typically do when we think something's going to go up? We buy stock. What can we do instead? We can buy an option, right? If you buy a stock, you've got unlimited upside potential. You have unlimited downside risk until 0. What can I do instead, right? I want to lessen the capital. I want a lower cost basis. I'd still like to have probability of profit around 50% or close, and I need to limit my risk. Remember, I may need to do this now. Now, those are all benefits I get one trade at a time. One trade at a time, I get that benefit. Overall, though, if I have enough of those one trades at a time, eventually I'm going to run out of capital. So again, if it's a nice, strong, right now, I probably wouldn't need it. I'm in a lot of cash right now. I think this market needs to play out, figure some things, right? It's got some personal issues it needs to sort through, and we need to give it some space. But if I were to trade, I'm definitely not going to take a lot of risk, right? If and when the market gets more bullish again, and I need to have 5, 6, 8, 10, 12 trades on, there's no way I can have 12 swing trades on at 1% risk and buy stock. I'll run out by 5, 6 at the very most. No way 12. I could go on a margin, really over leverage myself on margin, pay interest there, or I can use options, right? That's the advantage that it's going to give me. And what it does, gives me a better looking risk profile. So as you can see here, there's no longer just this straight line from one end to the other, right? Imagine that line was straight. That's what I was intending. Use your imagination. Instead, all of a sudden, it gets to this point here, and then it just sort of says, that's it. We can't lose more than that. We pay a certain amount. What are one of the biggest advantages of buying options? You cannot lose more than you put in the trade. And that's true for any debit strategy. A calendar spread, a bull call spread, or a bear put spread, those are vertical spreads. Buy an option. Those are all debits. When you buy a debit spread, you cannot lose more than you put into the trade. That's going to help you with risk management. You may try to find a way in this area to get out if it goes wrong so that you don't lose everything. But at any given time, worst case scenario, we have always are protected by the limitation that we cannot lose more than the cost of the trade itself. All right, moving right along. So that is a call option. A call option, and one of the appeals is definitely this. I have unlimited upside potential with a very limited downside risk. Now, I love the fact that I have unlimited upside potential. However, I have yet to realize it. Right? Yes, the option gives me unlimited upside potential. My analysis gives me very limited upside potential. So make sure that we understand what is our potential for gain based on the projections we have from our technical analysis. All right, let's keep moving. So much fun options. Probability of success. What is the probability of profit? Here's the thing, and this is actually built into options. If you buy an at-the-money call option, you'll typically find a delta of 0.5. What does that mean? That means if the stock goes up $1, I only get 50 cents of it. As that stock goes up, that delta will get higher. Another way to look at it is the probability of being in the money on expiration. If I have an at-the-money option, there's a 50-50 chance it's at the money, or it's in the money at expiration. Now, is that probability of profit or probability of, hey, it could go up or down? Probability of, hey, it could go up or down. That's not, I mean, if it doesn't know. If I pay $3 in premium, then it doesn't need to get to my strike price. It needs to get above my strike price for me to make money, right? It needs to get to here just for me. Whoops, wrong way. Let me go back. It needs to go here. There's my break even. No, back here. It needs to go at this point. So the expectations we build in a trade are going to be very, very important. And part of that is going to be, what is the probability of it going up or down? Now, probability doesn't always account for trend, doesn't always account for support and resistance. So I like to look at probability, but it's certainly not dogmatic. It's certainly not something that's like, oh, the probability is 7% off, I'm not going to take the trade. That's not what's going to happen. And yeah, that was my overly analytical trader voice. If you haven't heard that before, that's what it was. IV, implied volatility. What does it boil down to? Number one, we absolutely need to be aware of it. Does implied volatility tell me if it's a good trade or not? No. Does implied volatility tell me if it's more likely to go up or down or not? No. It does tell me if the market thinks it's more likely to go up or down, and that is information that I want to be aware of. Mostly, I'm using the options to help me understand how the options are priced. Implied volatility is low, options are cheap, it opens the door for me to buy the options. Implied volatility is low, is not low, right? There's either low or not low. There's not like low and medium medium high and high and oh, I need to make sure that, there it is again, the over analytical trader voice. There's low and not low. Low means options are cheap. It opens the door so that I can buy options. That's nice. I like buying options. I don't like buying expensive options. If the implied volatility is not low, that means the options are not cheap. They might be medium, they might be expensive, but if they're not cheap, I don't want to buy them. If they're not cheap, I want to sell them. And again, that's where understanding implied volatility and different types of trades can open the door, right? Can open the door for it. So Implied volatility absolutely needs to be something that you're taking a look at. In fact, let me grab my keyboard here. I was a little bit kicked back with my legs on my desk. Let me bring up a chart here. Let me add implied volatility. So what you're going to notice here on pretty much anything, the volatility spiked up quite a bit. It's pulled back some, but it's still quite high. It means options are expensive. If you buy an expensive option, let's say you buy calls today, and then the market does go up, the volatility keeps going down, time starts passing, time is working against you, volatility is working against you, only price is working for you. If I do a bull put spread instead of buying a call, time is now working for me. I collected a credit. Volatility is now working for me. A bull put spread is Vega negative. That would be beneficial. And time is working for me, right? Price, time, and volatility all working for me. So by incorporating this, by understanding how much of a role it plays and how options are priced, it helps you to understand that it needs to play a role in determining which option strategies you're most likely to build. Okay. I'm not getting many questions, so I'm hoping that means this is crystal clear. I'm also not getting much reaction to my jokes. I really hope it doesn't mean my jokes are bad. If it is, just tell me. I'll make adjustments. I can do better. I can do better, I promise. All right. Short. We think the market's going to drop. Do we? Yes, I think there's a good chance it does. Now, if you're a money manager, you're not gonna short stock very much. You're gonna hedge. That's actually mostly what's pushing the market right now, are institutions hedging. But if you are going to trade the downside, you would either short stock, which gives you a one-to-one upside and downside potential, or you're going to go find yourself some leverage, move over into the options and buy yourself, I don't have it. Buy yourself a put. If I buy a put, what do I do? Well, let's just say, for example, in this situation, I decided I'm going to buy a $24 put. And from that point on, I can't lose more than the cost of that trade if it doesn't go below that, right? So that's what it would look like for me. This is the most I can lose over here. This is the most I can make. So if it makes a big move, yeah, we can do quite well with it. So there you go. So instead of shorting, I buy puts. That gives me a negative delta. Now, a couple things to remember. Anytime you buy options, time is working against you. Time is working against you. We want options to be as cheap as possible. If you want options to be as cheap as possible, you want implied volatility to be as low as possible. The lower the implied volatility, the less you're going to stand to lose per day. That's the first thing. Second thing, you can see that being able to approach options from either side as a buyer or seller is going to be absolutely critical to you understanding how to be a professional options trader. Number three, implied volatility has a huge impact on the type of trade we build. But implied volatility nor the option Greeks, delta, theta, vega, gamma, those do not measure quality. They measure behavior. Oh, bigger vega, bigger theta, bigger vega, delta, any of that doesn't mean it's better. It's just bigger, just behaves different. Let me keep going. I do like talking about options. Probability of success. So if I buy an in the money option and I have a delta of 70, that's a 70%. Yeah, that's got a higher probability of success than a delta of 0.3, which is out of the money. However, the delta with the higher success, let's say I am successful and it makes a good move. The out of the money is going to give me a higher return on capital, even though it does give me a lower probability of success. Again, you have to be willing to pick your path. Am I more inclined to go in the money and be a little safer? Now, in a market like right now, the higher volatility, you have to go in the money. There's no choice. You do not want to buy out at or out of the money options when the implied volatility is high the way that it is now. Just don't want to do it. Can't do it. So there you go. There's always a scale. Remember, we talked about that scale. There's always a scale. Higher probability, lower return on capital. Same thing with spreads. Higher probability, less credit. Lower probability, more credit. We all have to pick our poisons. And there it is. I got done a little early. There's plenty of time for questions. This is your time. It's an open floor. Office hours are open for any options question. Throw it at me. I'm going to wrap up as you're starting to type it up. And remind you that here at Tradespoon, we offer good strategies, good forecasts and tools, screeners, ability to trade short-term, long-term, help with your entry and exit prices, very specific trend indicator, a lot of good tools. If you need additional hand holding, we have really good coaches, smart guys. Some of them are more handsome than the others. Scale of probability, where can we see it? Let me show you. And remember, you can always get in touch with us via social media. How to determine options cost. You don't determine the options cost. The market does, right? So scale of probability. Let me show you a couple of things in here. Research. Probability. And let's go to SPY. Now this is going to be fairly limited in what it gives me. Oh, the probability calculator seems to be off right now. Oh wait, here we go. It wanted to for a second. It was there for like 1 second, right there. Oh, that's the annual. I don't know what's going on with the probability. Can we go through examples, start to finish? What, like build a trade? No, there's no time. Sorry, and there's really no trade. Right? When you say start to finish means I need a setup, trend, support and resistance, candlestick. Then I need to determine a stop loss and a target. Then I need to determine a time frame. Then I need to go in and I need to plug that into a model. Then if that model, I need to figure out how much I'm going to lose if I'm wrong. Then I use that to figure out my position sizing, right? Then I can figure out the number of contracts. Then I can figure out if I'm right. Can I do that in 3 minutes? No. But you can see what needs to go in. Yeah, I rattled through that pretty fast. Go back and listen to that again. That's the secret to your trade. If you're not doing it at that level and wondering why things are going wrong, stop wondering. But as far as probability goes, I can show you this. Here's a probability model. So you can see what it's showing me is that from right now, there's basically, the way a probability model works is it's 50-50. At any given time from right now at this second, there's a 50% chance it goes up, 50% chance it goes down, which is why at any given time, if you were right at the money option, it would probably give you a delta of 50. Remember, probability models do not take into consideration trend. They do not take into consideration support or resistance. They do not take into consideration technical analysis at any time. So if you look at it and say, man, this thing's trending up, pulled back, it's at support. That looks great. You look at a probability model, the probability model is going to say, yep, you got a 50-50 chance of being right. Use it for what you will. I am comfortable with technical analysis, so I use it a lot less. I have worked with people who are not comfortable with technical analysis, and they have to rely on probability models a lot more. So hopefully that makes sense. How do I determine an options cost? So again, I don't. The market does. What I would do is determine an options value out in time, 3 or 4 days from now, if the trade goes against me, so I can quantify my risk. maybe 7 or 8 days from now if the stock goes for me, so I can quantify my reward. Then I can assess the reward to risk ratio. Does that make sense? I can take the risk level quantified and I can position size that according to that level. So it doesn't matter what it costs. What matters is, what is it worth if I'm right? What if I'm worth? What is it worth if I'm wrong? I'm even more confused than when I was when I started. Oh no, that's not good. Could you do another webinar that is even more basic, focusing on just the basics without bringing anything else, showing us a trade and explaining as you go along? Yeah, oof, I'm sorry. Listen to it again. Here's what I'll tell you. I remember I was a fresh-faced young man. I was working at Fidelity Investments. The year was 1998 or 9. And I'm studying options for the Series 7 exam. And I thought, I'm never going to get this. Here's what I'll tell you. You have to memorize things. You have to. You got to just spend some time memorizing. What does this mean? What are my rights? What are my obligations? I want this to go up. I want this to go down. Create flow charts. You can actually go onto like Google and type in like charts for buying options. Charts, right? So if I do this, what do I want it to do? What do I not want it to do? You have to. It's never going to be intuitive where you're just like, oh, that makes sense. You got to memorize it. So if you are new, go back and listen to the basics again. What is a call? What is a put? What are my rights? What are my obligations? And just write it down, memorize it. I'll tell you this. I thought I was never going to get it. And then one day I'm standing at a traffic light. I remember I went and ate at the Dragon Grill. Very delicious Korean barbecue. Oh, so good. Right? And I was eating and I was studying. My test was a few weeks away and I'm like, oh, I'm never going to get it. And then all of a sudden I'm standing at the light and I'm like, wait, I think I get this. And then from there, it just started making more sense. It's like you fight, and then you get the clarity. And then from there, you build on it. So yeah, I apologize. I tried to keep it. We need special food. Eat some Korean barbecue. Right? Make sure you put plenty of good sauce in there. But I will say that stay the course and just keep looking for the to memorize that. This is recorded. Watch it again. It'll make more sense the second time, I promise you. But as far as just building a trade, yeah, we could go through and build one. Right now, it wouldn't make sense. And here's my fear. Every time I build a trade, somebody inevitably takes it, no matter what. Even if I say, don't take this trade, this is an example. They're like, nope, you're building it. It's a trade. I'm taking it. So I'm always a little leery about building a trade from start to finish because somebody somewhere joined late and didn't hear me say, that's not a trade. And they're like, hey, your trade you built. And I'm like, no, I didn't build a trade. I showed an example. I didn't build anything. So you have to understand, I'm always going to be a bit leery that somebody's like, oh, I'm going to smash through and take that. Cece said they eating barbecue every week, but never any miracle thoughts. Change the sauce up. I promise you, it's in the sauce. It's in the sauce. So keep coming back to these. And what I would say is go backwards. If you liked our presentation, there is a plethora of these just on archive. Go back, find some good titles, watch these. They're a lot of fun. We do a bunch of different things. Just keep exposing yourself to options, and it'll help. So I feel terrible now. I'm gonna like close this meeting like feeling sad and a little bit bad about myself that I brought more confusion than I did clarity. But I'm gonna keep the course again. If you listen to it a second time, I bet you would. Never enough time is absolutely. And now it is time for a drink. Thanks, Rob. That's a good idea. Thank you, guys. I appreciate it. I hope I will do better next time, giving you more information on the options. It's worth it for you to learn, but it is a process and you do not want to skip any steps. Make sure you get the basics down before you go start throwing spread trades on. I hope you guys have a wonderful rest of your day. I always enjoy hanging out with you all. You know I love you very much. As always, happy trading.